Hello, my name's Simon Duke, and I'm the managing editor at Expana. Thank you for joining me today in this webinar broadcast live to you by Expana. We've called it 2026 Global Macro Forecast Trends You Can't Ignore. And my guest today is also someone you can't ignore. I have the pleasure of welcoming Tom Bundgaard. Tom is Vice President of Price Forecasting here at Expana, and he has more than 2 decades of specialized experience in commodity analysis and forecasting. Now, let's kick this off. Based on my research, one could say that the most striking feature of the global macro environment at the start of this year is that arguably the world economy has continued expanding despite an extraordinary sequence of shocks. Think of the war in Ukraine, which still rages, tightening monetary policy, and now renewed geopolitical tensions in the Middle East with the war. The US, Israel, and Iran conflict is that big one elephant in the room, and it's hard to look beyond that right now. And I guess it's fair to say that there is huge industry concern about how events pan out and what implications the economic consequences will have down the road on commodity markets. Despite this event, the consensus forecast by a whole range of senior economists from reputable institutions like the IMF, the International Monetary Fund, suggests that global growth in 2026 will remain around 3%, so similar to the previous year. Speaking in early March 2026, Kristalina Georgieva, who is the managing director of the IMF, described the current environment as one in which resilience is evident, but increasingly tested. She noted in an interview I read a couple of weeks ago that the world economy has been remarkably resilient, shock after shock, and yet growth is at 3.3%. But she immediately qualified that resilience with a warning about the fragility of the current equilibrium. This resilience is being tested yet again, she said. Now, Georgieva characterized the current macro environment as highly fluid, noting that the world economy is now navigating multiple structural forces simultaneously: technological change, geopolitical conflict, demographic shifts, and climate pressures. Basically, in early 2026, growth has remained stable, but the system is exposed to a growing number of destabilizing forces. And from what I have seen, a central concern among senior economists in March this year is the possibility that inflation, we'll get back to that, which had started to moderate in 24-25, could rise again because of energy shocks. The escalation of the conflict involving Iran and disruptions to oil supply routes have already pushed oil prices sharply higher. Economists are warning that energy markets remain the fastest transmission channel from geopolitics to inflation. Oil prices have surged, as we all know, after the geopolitical escalation in the Middle East disrupted supply routes. Brent crude rose to more than $112 per barrel this morning. That was the last time I checked, after Iran attacked energy facilities across the Middle East again. And this was after a strike on the South Pars gas field. Price per barrel, to provide a relative comparison, was only 103 a few days ago. Sustained rises in oil prices have measurable economic effects on both growth and inflation, and this makes energy markets one of the most important indicators for macroeconomists this year. Geopolitics have become a permanent component of macroeconomic analysis rather than a temporary risk. And while the global economy as a whole remains silent, economists also warn that emerging markets face disproportionate risks from rising oil prices. That's because countries heavily dependent on energy imports are particularly vulnerable to external price shocks. Now, Tom, over to you. Bear with me just for a moment. Now, as you know, I really enjoy listening to your presentations when you're on stage at our events. And I know that you like to make them colorful with a few references to some park or zoo animals, let's say, and you sometimes mention black swans or grey rhinos. Could you explain to our viewers in your words and with your slides what those are, and do you see any of those on the horizon?
Yes, thank you, Simon. Yeah, let's get into it. And I like to show colorful pictures and, as that. So let's go into black swans and stuff. Just a quick note first. I had, when we set this date, Simon, you and I, we set this date, and suddenly Iran came up. And it means that everything I had prepared, I had to chuck that out of the window, right? It's so obsolete now. So anything looking back at the previous months of this and that, all of those data is completely obsolete. It's like a dead fish wrapped in newspaper. It's so obsolete. So we had to sort of redo it all. Another animal. Yeah. Because right now, looking back doesn't make any sense. It's about looking forward. How is this going to affect the market, right? So, and the economy. So let me share my screen and let's get on with it. And I'll try to be very frank with my talk here. I'll give you my best estimate, not on one hand this, on the other hand. I'll try to be a little bit specific. I won't get it all correct. But what you mentioned is the animals, right? Black swans and gray rhinos. I'm taking you on a trip to the zoo, right? I assume everyone listening to this, that you know what black swan is, right? That's from 2001. It's a rare event. It's a high impact, but it's unpredictable. And the Middle East crisis is one of those. And of course, last year, it was tariffs, right? So a new year, a new black swan, right? That's the pace they're coming at. Of course, it belongs to black swans that once something happens, after the effect, there's always a bunch of people that said, oh, that could have been forecasted because there was early signs. And, there's always a bunch of people after the fact that says that could have happened, could have been forecasted. But basically, they're unpredictable, like tariffs and Middle East crisis. I think fewer people know gray rhinos, which is also a really important thing, and they are not unpredictable. In fact, gray rhinos are very predictable. They are known. This is Michel Boucaud who did that in 2013. They're very well known, high impact, but they're sort of neglected a little bit. So it's things that you sort of know have a high impact, but you sort of sweep it under the rug a little bit. So no one is sweeping under the rug that oil prices are going up and it's going to affect inflation. So that's not a gray rhino. Everyone is talking about it. But what I see very few people talk about is rhinos charging at us, and that is unemployment, the Treasury yield curve, construction, a number of things that are charging at us, and no one seems to talk about it. And you might say, well, there's a gray rhino charging towards you, and you're saying, well, I'll ignore it. And that's fine. You can do that until it hits you then. And then it's high impact, right? So I think today is looking at black swans and gray rhinos. So let's get on with it. The black swan of the Middle East. I think it's a bowling alley. We are right now inside a bowling alley. And I heard a clever man once said, when you're talking about wars, you have one decision, when to throw the bowling ball. When to start the war. After you let that bowling ball go, you can't decide anything more. The bowling ball is rolling, it's hitting the pins, and it's out of control, right? You can try to influence it, but you can't control it, right? And the ball has been let go, and now it's just to see where does it hit. So the first pin has been hit. That's the one on the left. That is crude oil, natural gas, plastic, aluminium, they're all going through the roof. That's the first casualty of this. Of course, those are the direct costs. There's also the indirect cost, fertilizers, transportation costs because of crude, production costs, and so on. That's the first pin. The second pin is inflation. Of course, PPI will go up and CPI, the consumer inflation, is going up. And it's a given that it's going to create some kind of inflation. How much, but it's going to be something. Energy is translated rather quickly into inflation. So that's the second casualty. And when inflation is rising, that will affect interest rates. Right? It will be difficult to put interest rates down. There's a risk they will go up. And that's another casualty. And if you take those two combined, inflation and interest rates, they will basically go up here and affect that pin over there, disposable income. This is going to lower the disposable income, meaning that we're spending more money on refilling the car, and so we have less money for buying new stuff. So spending might go down. Right? So that's another casualty. And at the very end of this bowling alley, there's a green pin at the very far end, which is GDP. So what we're trying to envision is like, what's the trajectory here, and how much is it going to affect all of this? Now, I've only shown you the obvious quick things here. There's probably 10, 20 more pins that I haven't shown, like unemployment, and there's unintended consequences of all of this, right? It's the pins are flying and hitting other pins, but this is just the simple way of showing it. It's a bowling alley filled with pins, and some are being hit and some are not. But at the end, that green pin at the very end is what I'm looking at. How much is that going to be affected? That's the question. Right? It's impossible to answer, of course, but let's try. So if we're looking at the pin at the end, that's this one. EU GDP growth right now is at 1.45%. If we take the US, it is 2.03%. Now, maybe just to enlighten, these two go in the same direction all the time. The world is interconnected, so it's always connected. Except there's a few things like here. You saw EU going down, and you saw US going up. There was a little bit of a disconnect there, and you saw the same thing here. US going up, EU going down. So that's a divergence. What we've seen since is a convergence, meaning that the EU is going up and US is going down, and they're meeting right here. Right? So now they're back on track, following each other, which is the norm. Right? And right now we're seeing a little bit of decline in both of them. So that's the current state of the GDP. So the question is, what's going to happen? What are the scenarios? Well, before this crisis, this is the scenarios we had before the crisis. Scenario one is that the economy has been going sideways for quite a number of years, and the green one is just scenario one is just continuing. And scenario two is that we were going to see a drop, a real recession. Right? Maybe not as deep as this one, but a recession. Now, it's good to know that we have different now. The majority of all economists that I'm reading, all the really good ones that I'm following, they are saying scenario one. And there's a likelihood that scenario one is going to play out. Our models indicate a slightly higher risk that scenario two is going to happen. And we've been saying that all along, right? Scenario two is the most likely. Of course, we could be wrong. And if we're wrong, then we're back to scenario one, which is what most people are pointing to. But just for the record, back in 21 here, this is where we laid out that 5-year plan. We said the first plan is a low growth, a decline in growth. And once you hit that level, it's not going to be a recession, it's just lower growth. Then we're going to have, from here and until somewhere in 25, we're going to have 3 years of sideways. So step one was a decline, step two was a sideways move, and then at some point, probably in 25, that's what we said back in 21, somewhere in 25, some-ish, we're probably going to see scenario two. I mean, this third one is a drop here. Now, we don't have a signal that we're going to see a drop. And until now, I must say scenario one has been the most likely of what we've seen until now, right? But now the Iranian crisis is here. So right, what's going to happen. So what happens now with the Iran crisis? I have a 1 percentage point decline. That's my back of the envelope calculations. I put 2 question marks on it because there's so much, but I think it would be reasonable to see a 1 percentage point decline, meaning if EU is 1.45%, it could drop to 0.45%, meaning lower growth, but it means no recession. So in itself, maybe the crisis, it's not enough to start a recession. Right? So that's the good news, right? The bad news, of course, is no one can calculate that percentage with any kind of accuracy. It's not an exact science. There's so many pins and unforeseen things, right? So you have to take that number with a grain of salt, right? That's just how it is. So I think maybe minus 1 percentage point. You have to divide that into timing. If the crisis lasted 2 weeks and then we're back to normal, it wouldn't impact the economy at all, right? The 1 percentage point is, if impending on the crisis lasting into summer, like reasonably few months, but a reasonably short time, but something like summer. The problem of if it continues longer than that, then it's not minus 1 percentage point any longer, then it's more, right? So that's the problem. So I listened to recently a webinar with a war strategist, an American war strategist. He was quite interesting to see. And I'm not going to repeat any of those things because I won't talk about the war as such because I'm not qualified to talk about the war. It was interesting. There was a lot of stuff there, but we're not talking about the war here. We're talking about how is it going to impact the economy. But there was one small point that he made, and that was the duration of the conflict, right? Because that impacts the economy. And he said, the Iranian is, he's been doing war simulation for the last 10 years or more, right? So he's really into this. This is outside my knowledge zone. But he said the Iranians have a strategy that doesn't include attacking anything or going against US in a war, right? They have no strategy of going against the US because they know no matter how they do it, they're going to lose. Right? No, their strategy is to hunker down, survive it as long as possible, prolong, that's the key word, prolong the conflict as long as possible, inflicting as much pain as possible on the energy sector, right? And that was a week ago I saw this. And of course, he's been proven right because the Iranians are bombing, gas and oil fields and 20 tankers. And, so they just want to inflict as much pain as possible and try to hunker in and survive because they have time on their side. The longer they can prolong this conflict, the more pain US is in and the more pain the world is in, right? So it's survival for them. That seems to point to that this is not going to be over in a few weeks or a month. Right? That points to this going on for longer. Right? That's the problem. And when the US asked for NATO ships to come and help, that sort of implicitly says, well, this is probably not over in a week's time, right? If we need ships, it's probably because it could be prolonged. So that's just the critical point is this may drag on because it's in Iranian interest to prolong it. The second thing is something people haven't really thought about, logistical bottlenecks. Even if it stops, let's say in a month's time, first they have to clear the mines that Iranians have done, right? We need to look at the insurance rates because they're preventing, the tankers from from shipping out, right? And they don't lower the interest, the insurance rate, overnight. And then the logistical bottlenecks is just horrendous. Typically, I've been trying to calculate, and it's difficult. I would say anything from 2 to 4 months, but probably more like 4 months before we're back to normal. And it could be longer, but it's a lot of uncertainty, but at least 4 months, I would guess. So once the crisis stops, it's going to last 4 months where things are dragging on with ships being rerouted and, congestions at the port, both material coming in and material coming out. It's just like after COVID, it took a long time before the whole congestion was cleared out. All of this seems to point to that even if it stopped today, plus 4 months, we are already in Q3, right, before we're seeing any relief. So, in our books, maybe 26 is all gone, right? It's all gone 26 before we're getting back. And that begs the question, is it then still 1 percentage point down? Right? That's the problem. It's so much uncertainty. What is certain is that if we go from, let's say, 1.45% and we go 1 percentage point down, it's not a recession, but it's getting more and more risky, right? And the longer it drags on, the more risk we are at. So that's the sort of the message here. And then I have sort of the good and the bad. The good is adaptability. If you throw a big rock in a river, you're just going to see water sloshing around it. Water will always find a way. And we saw the exact same thing in the Russian-Ukrainian war. We stopped buying in Europe. I'm based in Europe. We stopped buying gas from Russia. We bought it from US instead. Well, then we have to turn it into LNG and on ships instead, and we have to build harbor and stuff. But it got solved, right? We are so adaptive here. And I think the market is going to be adaptive. And I put that into my thinking and into my calculations. Of course, the market is going to be eminently good at finding solutions. Right? So one of the things is this map that we showed at the beginning. Of course, this is the problem area, but there's a couple of pipelines going over here to this port in the Red Sea. And that is going to be one part of the answer. There's another pipeline over here, and there's other things as well. And those 20 million barrels per day that is locked up here, those are, now they're gone, right? I think we will get 8 or 9 million of those out via alternate routes. Right? So in my calculations, I've sort of said, just the fact alone that we have these means that maybe 40 to 50% of the problem is sort of, in quote, solved. Now we're sending, they're sending oil into the Red Sea. That is probably solving 40% of the problem, and there's other issues coming up. And I think over the next month or so, there'll be more workarounds, adaptive things. And I'm very convinced that the market is so good at this, it will solve 50% of the problem. But of course, that means there's still a problem, and it's still a big problem. It's just not a 100% problem, it's a 50% problem. So I'm counting on this, and I know it's going to happen. So that's good. That's the good part. The bad part is the word compounding, right? It's I'm placing some rocks on this frozen lake, and when is the ice going to give away? Right, meaning a recession. Right. So what I see is that lots of people talk about the Middle East crisis as that's the issue, But no, I see 3 rocks. It's just the last of the rocks. I see we already have strained macro fundamentals. I saw that, right? They were already strained. And then that's one rock. Then we placed tariffs on top of the ice lake again. And I thought that could very well be the tipping point that makes it plunge through the ice, right? But it was remarkably resilient, right? And now we're placing the 3rd rock, the Middle East crisis. It's a compounding effect, right? Can the ice hold to just the Middle East crisis? I think so. But it's on top of the other 2 rocks. So when is enough enough? When is the ice not capable of holding it up? That's the big question, I think. So and that's the difficulty. I don't think the recession will start because of the oil situation. But if a recession starts, it's because of several things of that. So that's the idea. Maybe I'll just skip those for a while. Let's go back to the gray rhinos, because we just talked about the black swan. What are those weak fundamentals I'm talking about? It's inverted treasury yield curve, unemployment, interest rate, consumer demand and consumer sentiment and inflation and constructing so many. There's like 500 pieces to the macroeconomic puzzle, and we don't have time to go through all of them, right? But it's something we constantly follow. And it seems that some of these are sort of disregarded a little bit. So let me just give you 2 quick examples. Let me just go out of this. On the website, I mean, what we follow all of these data every month, so you can see them. Unemployment rates, this is the US. So let me just go full screen. Whenever you see, let me go back in time, whenever you see unemployment go up, typically you would always see a recession, which is here, like back in the 90s. And when you see unemployment going up, there's a recession here, back in the early 2000s. Unemployment going up, that's recession. Unemployment going up, this is a deep recession, but very, very short. Now we're seeing unemployment going up. This is like a gray rhino charging at you. And if I look back at the data back to 1950s, every time unemployment went up, there's always been a recession. So does that mean it will come this time? Well, you could say, well, this time is the exception. There's not going to be a recession this time. But I haven't seen a period with rising unemployment where we didn't get one. So I am open to the fact that we could just have scenario 1, stable economy. But if you ask me to place a bet on it, why would we avoid it this time? That's the problem, right? Another one, if I go to, let me take this one and go to figure here, let me show. We have so much data here, that's the thing, but I'll keep it relatively short and brief here. This is the inverted treasury yield curve. Everyone agrees, not just me, but everyone agrees that this is the best indicator for, since 1912, we have more than 100 years of data. It's always correct, right? So let me just give you a quick one. When it's inverted, which is when it's below this line, this is inversion, and then the recession comes. But after a while, when it's inverted, all the papers are writing, oh, it's inverted. That means a recession. But yeah, it doesn't come right away. There's a delay, and then the recession. These gray bars are recession. It breaks below, and then there's a recession, right? It breaks below here, and then there's a recession. It breaks below, and here a lot of people saying it's not going to happen, but of course it did happen. And it breaks below here. So with a certain delay, we should be seeing a recession. So you might be able to say, well, yeah, it's been working for 100 years, but this time it doesn't work. That's the thing. I don't hear anyone talking about the inverted treasury yield curve. They're not paying attention to it. And they're not paying attention to the unemployment. Right? So it's like they just want to sweep it under the rug and don't mention the rhino that it's charging at you. Just stay grounded and close your eyes. You'll feel it when you feel it, right? That's the problem. So that's what I mean when I'm talking about gray rhinos. It's actually stuff like that that is being swept under the rug. Apart from that, there's other, the economy also has some good things. It's always a mixture of good and bad things, but there's a few rhinos that people don't want to talk about. But yeah, of course, we do this every month. We make a webinar on the macroeconomy, and that's for subscribers. But today it's an open one. Everyone can see this, so it's just an open one. Because of the Iran thing, we think it's good to do it as an open one. So basically, that's the conclusion of the things, and Simon will get back to the conclusion. But you can see it's worrying. The economy is going to go down somewhat, and the longer this Iranian problem is here, the deeper the decline is going to be, and we're getting awfully close to a tipping point. How many rocks can we put on this sheet of ice before it breaks? Right? That's the big question. And no one can calculate the answer because it's not an exact science. It's just worrying. Right? So that's the point. Now, one of the things Simon just reminded me, this is the macroeconomy, but he reminded, let's talk about crude oil as well. And I think we gave a little bit away earlier. Let me show you a little bit on crude oil. This is one of the models we are doing here for crude oil. This model here is what we call our regression analysis. It means that we take decades and decades of supply and demand figures, inventory data, speculative data, currency effects, everything, and put them into a sensible model saying whenever something changes, like speculators or inventories, we can see the effect on price. And then we calculate what, based on all of these factors, what would be sort of a fair price, an estimated price that is sort of reasonable, based on how the fundamentals are. And that's the gray band that you're seeing here. Now, the value comes when you put crude oil prices on it, right? And of course, you can see I haven't updated this yet because we are already up here now, right? So this is where prices are, which is like between 105 to 110. It's very volatile even through the day. So what we said is that whenever prices are here, this is where they were. If you just look at this is December 25. We said these prices are unrealistically low. We've seen a decline in crude oil going from here to here, and it has taken 3.5 years. Just mark that, 3.5 years of continuously falling prices, which is, it's great if you're a buyer, but it's starting to become unsustainably low. The good thing about this model is you can see when it's unsustainably low, like here, right? Or like here, or like here, or like here. What does all of these points have in common is that you can see on the model, this is unsustainably low. There's just one way this is going to go, and that's up. And that means like this, or like that, or up like this, or like you saw here, boom, like that. The only response, we said, is going to be an increase. So this is the level it hit in December. So on the 14th of January, we told all our clients that if you're seeking, hedging opportunities, this might be a good idea to sort of secure your purchase for the entirety of 26. And so people that listen to that is really happy now because they're not being hurt by this price increase. It's not without its thorns because we said 26 is a goner, right? You got to, this is the time to do something, right? For 26 in a short while. we're going to issue the same thing for 27. So we have this on tape back in January the 14th and on video. And the thing is, the sad thing is that all of a sudden, the Iran crisis just boom, and then that hedging 27 was no longer an option because prices went up to 120 in a jiffy, right? So that 27 was gone, but at least 26 is not an issue anymore. Now, what I've shown you is what I call an anti-bubble. This is an anti-bubble here and here and here. But you also get bubbles. I mean, that's what people that term is very normal, where prices get unsustainably too high. And you've seen that over here as well, unsustainably too high. I was analyzing crude oil over here when we were back in 2008. This was a bubble. I went on record to say, you're going to see the biggest decline you've ever seen in history for crude oil because prices are unsustainably too high. And I was laughed at in conferences. And of course, now you get that decline because it was unsustainably too high. But I think we're going to see the same thing. We're going to see a bubble like this, a sizable bubble on top of this fair band. But, we said the fair band here has a range of up to 97. If you're coming from 60, just no problems at all, you'll get to 90 plus just by regular commerce, right? No issues, no Iran, no nothing. In January, we didn't know about any Iran wars, right? We said without any disturbance, we're easily going to get to plus 90 and very fast. So that's why we wanted to hedge all of 26. If there's any kind of disturbance, we're going to get higher than that. And our forecast was above 100. Right? At the end of at the end of 26, we're going to get above 100, and in no time at all. Of course, that's been proven right. But the problem is that the fair band is going up now. So we're still going to get into a bubble. It's going to go too high, and that's because of panic. Of course, prices makes panics, bubbles. It's the market panic that sends us into a bubble. So I could show you lots of stuff here. We have speculators, cost drivers, inventories, some supply and demand balance, and all kinds of things, and a forecast. But it's just to show you this is the kind of thing we normally do, right? And we do that for all commodities. So it's just to give you a little taster of that. So with that out of the way, I think that's sort of the general, I'll stop sharing here, but that's the general view. Simon, you got anything on this?
No, that was fascinating. Thank you, Tom. Some really good points you made there. I was going to ask you, could you do the same for liquid natural gas? Could you do the same for aluminium? There are so many indicators, but we clearly don't have the time to go into that. And as passionate as you are about it, we simply don't have the time. So I would very much invite our viewers to connect with us after this webinar, because all of that information is on the Expana platform and information that Tom tracks very, very closely. So to leave a bit of time for eventual questions coming our way, I'll just go through some concluding remarks, if that's okay. And I want to thank you, Tom, again for your expertise in walking us through such a complex landscape. And what's abundantly clear from your overview today is that geopolitics is no longer a temporary risk to macro forecasters. It's a permanent component of your analysis. I think the Middle East conflict today is demonstrating that very vividly. So for those watching today, many key messages I think that were put out there. Macro indicators, watch them closely. Inflation, CPI, PPI, some of those bowling pins that were further down the alley. And of course, the commodity price movements, which we track very closely. So Expana will continue tracking these developments for you very closely. And we encourage you to stay updated as the situation evolves. And we look forward to bringing you more market insights that you cannot ignore in upcoming webinars. One such webinar coming next is called From Market Noise to Strategic Signal, Overcoming Short-Term Bias in Volatile Markets. That's taking place Wednesday next week and will feature our managing editor, Jamie Chadwick, but as well as our guest, Sébastien Lavoie, who is Director of Procurement at Leclerc Foods, and Derek Nelson, who is Director of Commodity Risk and Analytics at Little Caesars. As you can see, there are some. I'm going through a few slides here on, what you can also expect on Expana with all the various price points and the data aspects that we have. There's a nice little glimpse of our platform, and we strongly invite you to go and check expanamarkets.com to find out more. So really insightful, and I really appreciate the scenario planning that you gave us a glimpse of today. It seems that we don't have any time for questions. So please, I'll leave our audience then today with some takeaways. You have them in front of you, 3 takeaways that you can look at. A replay will be available for this webinar, and if you have any questions, don't hesitate to send them after this webinar to your contacts at Expana. So all I can do now is thank you, Tom, for a great presentation and for entertaining me with some great comments, and for listening to my spiel as well. I appreciate it.
I'll bring some more animals next time or something. Cool.
And to everyone here, I appreciate your time joining us on this webinar. Follow the Middle East coverage on Expana. Stay safe, and see you next time. Thank you very much.
Thank you.